Hello and welcome to this video on basic accounting, debit credit exercises part 1. So this video will be a two-part thing, and this is the first part of those two videos. So at the end of this video, and by this video I mean part 1, you will learn, or I will give you a basic introduction to assets, liabilities, equity and profit and loss. And I will talk about that for about 10-15 minutes. It's going to be a little bit tough if you have no accounting experience, but if you are a complete beginner and if you are a quick learner, you might be able to tag along. Then I'm going to show you how to understand and perform these 7 fundamental transactions. And the first one I'm going to go through is the first transaction of any company when you open your company. And then we're going to go through some cash transactions without VAT. And by cash I mean you are going to transactions where you pay your vendor with money right away, so no credit, or you receive money from your customer right away, so no credit. And then I'm going to go through the same 3 transactions, but this time it's going to be with VAT. So these 3 transactions up here are more simpler because they don't contain VAT. Whereas these down here are a little bit more complicated. And then I have some advice here, which first is the audience. So the audience, it's really meant for brushing up, but it could also be for beginners. Although it's going to be a little bit of a steep learning curve or uphill, but you could do it. Then the advice would be to watch this video several times, and I'm saying this because you shouldn't expect to be able to watch this video just once and then you are fluent in debit and credit and accounting. You should also download the Excel sheet that I'm using, and you should try to do your own exercises and see if you can achieve these transactions as well. And you can always correct them or see if you are right by comparing them to what I do. Alright, so as I've mentioned, this video is the first in a pair of 2 videos, and I'm just gonna go quickly over what you can expect from the second video. So the prerequisite of the second video is that you have seen this video, part 1, and understood that. And at the end of this video, being the second part, the part 2 video, you will understand how to perform these 11 fundamental transactions. So they all build on the transaction you're going to learn in this first part. And the first one we're going to have a look at in the second part of the video is how you book if you loan some money from the bank. And then we're going to go and have a look at some credit transactions. In the first part of the video, this video that you're going to watch now, or that you're watching now, we are focusing on cash transactions. And but credit transactions means that you're not going to receive the money right away, and you're not going to pay your vendor right away. So your vendor has given you maybe 1 month of credit, and this is booked differently than if you pay your vendor right away with cash. So those would be the 4 first or the 3 first transactions, credit transactions without VAT. Then we're going to have a look at basically the same 3 transactions, but this time and it's going to be credit, but this time it's going to be with VAT. Finally, I'm going to take you through the 4 remaining main transactions in a trading company, and really when you've gone through these 2 videos, I think you'll be able to understand about 90% of all the finance and accounting that goes on in a company. So so have a look at these, and when you feel comfortable with these transactions, that's when you can start looking at my posting group videos and the other more NAV related videos that I have created. Okay, so but before we get started, let me just give you a quick introduction to this Excel sheet. Out here we have our GL, or our chart of accounts, all the way downwards here with all our different GL accounts. We have our assets area here with the bank account, an inventory account, a purchase VAT, and some receivables. And then we have our liabilities here with the shareholders, sales VAT, a loan and payables. And then we have our profit and loss down here, which is with a sales area and with a cost area. So just a few comments about the balance sheet. And the balance sheet is the word for the assets and the liabilities combined. So this is, you've probably heard that a balance sheet must always balance. This means that at any given point in time, the total sum of your assets and the total sum of your liabilities must be the same amount. And the assets is really the area where you can see how much value, or how the value of the company is distributed between different assets or different kinds of value. So the bank account is the account where we have where we note how much money we have in a bank. The inventory is the account where we note how much inventory we have. And I'm sure you can relate to that. Money in the bank is value to the company. Inventory is value to the company. We also have purchase VAT, and purchase VAT is an account where you book all the money that the VAT authorities owe you. So that's definitely also of big value, because they will pay us these money, or they owe us that. And the receivables is an account that we use to book money that our customers owe us. So the receivables account and the purchase VAT, it's not money, it's not hard money, we can't spend them, but we are almost 100% sure that in a month or two maybe they will turn into money. So they are almost as good as the bank account. The same with the inventory. It's not quite as good as a bank account, but it's almost hard cash, because we are expecting to sell it. So these are all the values of the company. And then we have the liabilities down here. Sorry about that. Then we have the liabilities down here. And the best way that I like to look, well, there are two ways you could look at the liabilities. Either, and this is the way that I usually look at it, I say that the liabilities are a list of those people, or those companies or individuals who own the assets. So all of these assets have a total value, and the shareholders, or the equity, own some of that total value. Sales VAT, which is money that we owe to, or the company owes to the tax authorities. So you could say that the tax authorities actually also owe some of this the tax authorities also own some of this value in the assets. And if we have taken out a loan in a bank, then our bank also own some of this money, or some of this value. And finally, if we have our creditors are the vendors we still haven't paid. So these creditors also own some of these assets. So assets can be considered how much value we have in the company, and then you could say that the liabilities is a list of how that value is distributed between, well, partly the owners, but also other interests, other entities that have an interest, or an asset actually in the company. And then we have the profit and loss down here. This is mostly familiar with most people, because this is where you register your sale and your cost, and when you subtract those two, you could have a profit account down here. So that makes more sense. But what is a little bit confusing, or to most people, maybe this will help. But actually, the profit and loss area is really a sub account to the, and this now it's getting a little bit complex. So close your ears if you don't want to get confused. But the profit and loss area is actually a sub account to the equity. So whenever we increase our sale, that's really good. That hits directly the owners of the company. And whenever we have a cost, that hits the owners of the company directly. So the profit and loss area is a sub account to the equity account. And you might be able to argue that back in the days, you didn't have or when accounting started, you didn't have the profit and loss area here, but you had just the equity account. And whenever you sold something, you increased the equity account. You just increased it by the amount that you sold. And whenever you had a cost, you decreased the equity account. And actually, you could run your company like that. But obviously, you would end up with a ton of transactions on your equity, and it is to get an overview. It's going to be impossible. So that's why it's easier to keep your equity, this sub account as a profit and loss, and divide it into first the sale and then the cost. And then at the end of the year, you take all of this money from the profit and loss and you put it up to the equity account. And that's actually what the close income statement batch job in NAV does for you. And we'll get back to that in a little while. So that was a quick introduction on the chart of accounts, or the GL accounts, or the balance sheet and the profit and loss. Then if we look outwards here in our Excel sheet, we have the green area here, which is purchase and sale for cash. So this means that when we sell something, we actually receive the money right away. At the moment we sell something, we receive the money. But also when we buy something, we actually pay our vendor right away. So this is in contrast to the blue area over here, where we purchase and sell on credit. So all the transactions here, we don't pay immediately. We might pay our vendor 1 month down the road. And the same goes for when we sell something. We might not receive our money until a couple of months later. So this has implications to the way these things are booked into our accounts. Then if we go out here further, we have 4 more transactions. And the first one is where we pay our vendor, how that looks. Then we have we receive money from our customer, and then we move the profit to the equity account. And that was what I was talking about when I said that the profit and loss, this one, is actually a sub-account to the equity. And this is related to the close income statement batch job in NAV. And then the last one, the last transaction is called buy an iPad the Navision or the NAV way. And this is going to be slightly different than the transactions over here, but we have to go through these transactions in order to really understand the last one here. But this will explain how NAV handles purchases. All right, so let's look at the first transaction here. When you start a company, you have to put some money into it. And in this case, we have decided to create or start our company with $1,000. That's probably practically not possible, but in this case, it's a nice number. So $1,000 we're going to start our company with. And those are hard cash, and typically they will be put on a bank account. They could also be just in actual physical money, but nowadays mostly you would put them on a bank account. So when you start your company, your bank account rises with $1,000. And then to stay in line with my explanation of what liabilities are, we would have to indicate who owns these $1,000. And when you start the company, assuming you're just one individual that starts the company, you own all of the assets of the company. So you own all 1,000. So this is our first debit and credit. In NAV, credits are always minus and debits are always plus. So you can also see that the balance of this transaction is 0, so the debits and the credits balances. And we now have 1,000 in our bank account, and those $1,000 are owned by the equity or the shareholders or the owners of the company, which is represented by a credit of 1,000 here. So the next transaction we have is on the very first day you open your company. You want to celebrate this with a pizza. So you go and you buy a pizza at the local pizza store. For some reason he doesn't expect you to pay VAT. It's not completely realistic, but just to keep things simple, we're going to assume that it's without VAT. So buy a pizza, instant consumption, no VAT, and it costs $50. So when you buy a pizza, this has, and you eat it, it doesn't have any value to your company anymore. And when you buy it cash, you have to pay for it right away. So your bank account suffers slightly. So we have to credit our bank account a little bit to reduce it. And this represents a cost to the company. So down here we have to create a new expense account. So we're just gonna say insert here because we need these accounts for something else. So I'm just gonna call this expenses, like that, and that would be $50. So this actually would raise a question probably for you, because costs are usually minus, or the normal way of thinking about cost would be minus, but I just entered 50 here and the minus 50 up here. Why is that? Well, the longer explanation is that the profit and loss account down, or the profit and loss area down here, is a sub account to the equity, and equity is by default credit, so it's in minus. So right now the equity of the shareholders, or in this transaction the shareholders owned all $1,000 of the company. But now they have just spent a pizza, so they need to own $50 less. So we could also have made this number smaller, so say 950. But as I explained before, it gets too muddy and too complicated if you book all of your expenses on the equity account. So that's why we have the profit and loss account down here to do that. So if we were to reduce this to 950, because the company is now only 950 worth, so the equity or the shareholders now they are still the full owners of the company, but the company is only 950 worth. If we were to reduce that, and if it's already minus, we would have to put in plus 50 here to get that down to a credit of 950. So plus 50, and that's why the cost is plus 50. It takes a little bit of getting used to, but in NAV it's like this. The assets are by default plus, as in debit, and the liabilities are by default minus, as in credit. So the minus and the plus doesn't really mean the same thing as it usually does. It's rather a sign for debit or credit. And it takes some time and some exercises to get used to this. But what we can see now is that the balance, or this transaction balances now. We've spent 50, so our bank account has been reduced by 50, which, by the way, we can actually see out here because this is a balance of the bank account. I have made this field so that it summarizes all the cells or all the fields along this line. So we can see that it's now 950. Actually, it might look like we still, the company is still, or the equity still has a value of 1,000, but this will change when we move the profit and loss, when we run the closed income statement. So you can't really trust this figure. You have to take into the account everything else which is also in the profit and loss. So the total here should be minus or credit 950. Alright, so the next transaction here is still purchase and sale with cash. It's with no VAT. We'll get to the VAT in a moment, but it's with no VAT. So, and it says buy an iPad for resale, no VAT, and it cost you $300. So we know that when we are buying something in cash, we have to give the money right away. So we have to make our bank account smaller, or credit that with 300. So now we only have $650 on our bank account. But we need also to do something else, because right now this transaction doesn't balance with debit and credit. And when you buy a stereo, it might have a negative impact on your bank account, but it actually has a positive impact on your inventory account here. So actually, the total implication of buying an iPad is actually zero. It's just a question of us. We convert cash from what cash we have on a bank account. We convert it from one kind of value to another kind of value. So we take out 300 from our bank account, and we put those 300 into our inventory. What is also interesting here is that buying an iPad for cash actually doesn't have any implications on our profit and loss. It hasn't made us any money, and it hasn't cost us any money when we consider the value of the company. It's just converting one kind of value into another. So the next transaction here is called sell your stereo, no VAT. And I'm going to put in a price for this stereo. So let's say we sell that for $600, like this. So when you sell something, I usually say that there is an upside part and a downside part. The upside part is the sale. When we sell something, we receive money from our customer, and our bank account increases. So all of a sudden, it's up to 1,250. And to balance that out, we have to indicate this actually on our equity, but because we do all equity transactions in our profit and loss, we have to put it in our sale. And this is also a little bit confusing, because just as the cost is positive, the sale is indicated with a minus. But once again, minus doesn't really mean minus when you are talking debit and credit and accounting. Minus really means credit. So the transaction is really to symbolize that the equity has increased here, but we do this down in the profit and loss because there's not enough room, or it's too it gets too messy when we do it up here. So we would have otherwise increased this one by 600, but we do it here down in the profit and loss. So the thing though, when we sell something, is that it's not all good. It's not just all good. There's something downside that happens as well. And the bad thing that happens is that our inventory is reduced because all of a sudden somebody removes this iPad. Oh, it should have been iPad here, like this. All of a sudden somebody removes the iPad from our inventory. So what we just bought in the previous transaction and we're selling here, although something really good happens, our bank account increases by 6 and the and our equity increases, or our sale increases by 600. Then the downside to this occurrence or this transaction is that our inventory falls by 300. And remember that when we are in the assets area, when value is going down, it is credited like this. So this has to also be counterposted really in the equities account, but we'll put it down due to limited space. We'll put it down in our profit and loss, and this is called the cost of goods sold. So cost is debited, so that is with a plus in front here. So we can see now that when we sell our iPad, we have made 600, but we have also, you could say we have made 600 here, but we have also lost 300. But it's pretty good because we have a profit of 300. Alright, so in the next transaction here, we're going to do transactions with VAT. Before here we had without VAT. So it was a little bit easier here, but we're going to get few more transactions over here. So the first transaction is very similar to the first one we had, or the one we had over here with no VAT. It's buy a pizza, instant consumption, but with VAT, as opposed to no VAT here. So when we buy a pizza with VAT, the pizza guy is obliged to, he has to charge also some VAT. He can't get away with just receiving $50. He has to charge some more because the tax authorities will expect him to pay this. In fact, they have told him that he needs to charge some VAT, which he needs to pass on to the tax authorities. So when we go and buy our pizza, although it really should cost 50, he has to put VAT on top of that, and we have to pay that VAT to him. He will eventually pass it on to the tax authorities though. So as we are paying still in cash, and the VAT, let's say the VAT is 20, we will have to pay really not 50, although that is the price of the pizza, but actually 60. So our bank account is reduced by 60, like this. And this needs to be counterbalanced, of course. So the first place that we need to counterbalance this, these 50 are down here in expenses. So we've had an expense of 50 because the pizza really cost 50, but we have paid 60. So that means that when we pay this pizza guy 50, we can actually get those that VAT back from the tax authorities. So that is a purchase, that is called purchase VAT, and it's an asset. So we are allowed to put $10 here, and the reason it's an asset is because eventually the tax authorities will have to pay this back to us. It's a little bit confusing, but really what happens is that we pay $10 to the pizza guy, who then has to pass that on to the tax authorities, and to, you know, it's actually those $10 which are ending up being paid back to us. So so the total implication for us is zero. So it's actually not a particularly bad thing for us that we have to pay more than 50. That we have to pay 60, because at the end of the year, or at the end, we will get those $10 back from the tax authorities. So the the net effect of this is that we've had an expense of 50, and of those 60 that we pulled out of the bank, 10 of those will be given back to us from the tax authorities. Alright, so the next transaction here is quite similar to the one we had over here, where we bought an iPad for resale, but it's with VAT now. So we're buying an iPad for $300, and like in the case of the pizza guy, whoever sells us this iPad is also supposed to charge us for the VAT. And let's say it's 20 again. So 20% of 300 is 60. So he would expect us to pay 360. So once again, it's on our bank account. So our bank account is reduced here, and it's not an expense because we don't eat the iPad, so it's not gone. We did eat the pizza, so it's gone. So that's why it's a cost right away. But we haven't eaten the iPad. It still has a value to us, and we have put it on inventory. So 300 of those 360 we can put on inventory. So, but the transaction still doesn't balance entirely. So the last minus 60 up here, or we need to book another 60 to get rid of these minus 60, and that is also on the purchase VAT, like this. So what we can say about this transaction is that we've paid 360 for our stereo, for our iPad. Our inventory though has increased by 300, and the tax authorities owe us 60. So the final transaction here in this green box, which was purchase and sale with cash, is sell your stereo with VAT. So it's very much similar to this one, but it's just with VAT. So let's sell it for 600 again, but this time we are the ones that have to charge VAT. So when somebody comes and says that they want to buy our iPad, sorry about that again. So when somebody comes along and says they want to buy our iPad, we'll have to sell it for 600, but we'll have to top it up with some VAT. And 20% of 600 is 120, so we have to make them pay us 720. The 600 plus the 120. So this is really good for our bank over here. But there is some VAT, because those 120 VAT that we had to also get from our customer, unfortunately we don't get to keep those. So eventually we'll have to pay those back. And down here we have something called sales VAT, and we will have to credit this one with 120. So although our bank has risen by 720, unfortunately 120 of those have to be given back to the tax authorities. To make this transaction balance, we can see that right now it's out of balance with 600. We have to book this into our sale down here. And we've seen before that the sale is always credit, so we'll put in 600 here. And then the transaction balances. But this was only the good part of of selling your iPad, so this was the upside part. But something downside or something bad also happens when we sell our iPad, and that is that it disappears from our inventory. So we have to reduce our inventory here by 300, which was the value of the iPad. Unfortunately now it doesn't balance again. So how do we get this corrected? Well, we have an account down here, which we also used over here, which is called cost of goods sold. And this is really the counter posting or the balancing posting for these 300. It's to the cost of goods sold down here. So now we have 5 entries here, and these 5 entries are actually the 5 entries you usually see when you sell a FIFO item, which is the normal costing method in NAV. You'll see these 5 entries. Alright, so let's try to see how our company has performed for during these 5 transactions. So first we can see out here in the balance, so each of these fields down here is the sum of the fields lying outwards here, and we can see that it totals or sums to 0. So this is the sum of all the way down here. So we can, if we take these figures one at a time, we can see that we now have 1,550 on our bank account, which is good. So it looks like we've made some money. We also we are owed, or the tax authorities owe us $70 worth of tax. And if we take our total assets downwards here, we'll see that our assets summarize to $1,620. So we should be able to, if we look at the liabilities, because the balance sheet always has to balance, we should be able to also find those 1,620. So if we do that like this, and we look down here, well, what's that all about? So when we summarize the liabilities here, it actually doesn't give us 1,620. And that is because a big chunk of what should be on the equity account is actually found down here in the profit and loss. So if we make a total or summarize the profit and loss to see our profit, like this, first of all, we notice that it comes out with a minus, and minus is credit. So this is actually a good indication. This really means that we've had a positive year. So our profit and loss here is in credit, and that's good. So if we were to add these 500 to our liabilities up here, we get 1,600, not 100, but 620, and that happens to be exactly the same as what our assets were. So when if we consider this the first year of our company, we could now choose to book all of these, the totals. So we would book 1,200 up to the equity here, and we would book 100 up to the equity, and we would book 600 up to the equity, and that would raise the equity with 500, I think. Anyways, the total in the liabilities would be 1,620, which was the same as the assets. So it balances, and it looks fine. What we can also see in our liabilities here is that unfortunately we owe the tax authorities 120, which is out here. So our total tax outstanding is, although the tax authorities owe us 70, unfortunately we owe them more. So in the end, we'll have to pay the difference between these two to the tax authorities. And that is also why some, or most companies, in fact, just about all companies, have these two accounts in the same area in the liabilities. But we can get back to that in another video.